Good afternoon. It's afternoon. I have to readjust to that. Welcome back to the Trading Index Options webcast. My name is Ben Watson, and I'm an education coach and senior manager here at Charles Schwab. Let me make sure that I'm focused on the right time of day and the right class so that we are in the right place. My thanks to Brent Morris for being out there in chat to help keep things straight and keep the answers flowing. My thanks to all of you for being out there asking questions that require answers, which is a good thing. And we're going to jump into index options. On this Fed day, we're going to talk a little bit about hedging after the fact, which sometimes seems a little bit like closing the barn door after the horse has gotten out. But we'll see if that is, in fact, really the case here. We'll also take a look at our 14 days, 7 days structure that we've been looking at, see if we need to make a change to that. And we'll keep that conversation going. Again, my good friend and fellow educator, Brent Morris, is out there, 20-plus year veteran in the financial markets. He's out in the chat helping to answer your questions. If you're in the recorded version, leave us a comment in the comment section. We'll get back to you on those as quickly as possible. So a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. Nothing that we talk about should be construed as any kind of a recommendation, including individual symbols or strategies or account types or anything else. Remember that investing involves risk, including the loss of principal. Past performance, no guarantee future results. Equity and index options carry a high level of risk. They are not suitable for all investors. Make sure you're aware of the characteristics and risks. Standardize options before considering any option strategy. Also, remember that index options are a little bit different. Index options that we'll talk about are cash settled. They do not settle to shares of or short positions of an underlying stock because there is no underlying stock. So they settled cash or nothing. And so we'll talk about some of those characteristics. Also, the types of index options that we're going to talk about in this class today generally are going to be European style options. That means that they cannot be exercised prior to expiration, which means that there is not a risk of early assignment. However, when you're trading American style short options, which is the vast majority of equities and some indexes, those American style short options can be assigned at any time because they can be exercised at any time up into and including expiration regardless of the in-the-money amount. So we're going to talk about some of those characteristics. One of the things that we're going to do, since we're going to be using the Thinkorswim desktop software platform, specifically the paper money version, which isn't a guarantee of future success out there in the real world. It's a great learning environment, but it does not facilitate the early assignment of short options. So just be aware of that. There are some other differences that it has. Also, remember that technical analysis, probability analysis, fundamental analysis, all of those are theoretical in nature. None of those are guaranteed as to what the market is going to do. So let's take a look at what we're going to jump into today. I've got a couple of different approaches that I want to talk about. Specifically, I want to talk, since we're coming off of the FOMC meeting, I want to pop back over here. I want to take a look at our charts. And I want to look at what's gone on today here in the S&P 500, the NASDAQ, and the Russell, the indexes that we generally talk about, and get a sense of what has been going on. And Scott asks a great question. He asks the question in the chat, does the VIX go dark during the Fed press conference? And I'm going to ask Brent to double check me on this, if he wouldn't mind. But my understanding is no, it does not. But the likelihood of not seeing a lot of VIX movement during that scenario is the fact that many institutional traders, if not most institutional traders, are very likely focused on listening to the press conference and the rate decision, and therefore you may see lower trading activity and lower trading volume during that time. And thank you, Brent, for double checking me on that. I think it is still available and still moving during that time. You just may see a little bit of a lull because everybody's focused someplace else. All right, take a look at the SPX and let's see what's gone on here in today's trading. So we've seen a bit of a bearish engulfing candle at the top of this little run. So gap up rally, gap up rally, gap up rally, gap up into a doji almost yesterday, and then a bit of a gap up into a sell-off today. Not an abject sell-off, just a bit of a profit-taking sell-off, but still nonetheless a bit of a bearish engulfing candle up here at the top. If we take a look at the 5-day 5-minute chart and just kind of see what's happened, here is that post-speech move. We see kind of one big candle, and we see maybe a little bit of a bear flaggy type movement here on the 5-day 5-minute candles. And a lot of that maybe has to do with the fact that we had kind of two statistical outliers from the Fed governors in terms of their understanding and their votes. One was to not cut rates, the other was to cut more. And so that's kind of bracketing. So you throw out the high and the low like test scores, and you get right down the middle where everybody was voting for one quarter point cut. And that's where kind of the market is digesting that information at this particular point. So seeing that rally up and then maybe that little bit of a pullback at the moment here. And again, now kind of sitting here at this level. So some downward movement nonetheless, but now we're kind of sitting maybe with a little bit of a rally back up here, starting the potential of a bull flag type of move. And if that's the case, let's take a look at the NASDAQ here. And whoops. Let's see if we can get that going. Whoops. All right. Okay, NASDAQ right here. There we go. There's the NASDAQ. NASDAQ saw a little bit more of a gap up and rally here in that move. Whoops, I got to put this at 6 more. Okay, there we go. All right, so a little bit of a gap up and a bit of a sell-off. Not as much of an engulfing pattern here in this particular case, but for sure, kind of that same type of element. And let's take a look at the 5-day 5-minute here just to kind of get a sense, and doing exactly the same thing, coming back up off of that 200 period moving average, which had been getting closer. The 200 and the 50 had been getting closer. Now, these are 250 5-minute bars in this particular case. And so starting to see those coming a little bit closer together here. So that being the case, again, a little bit more bullishness, maybe a little bit of a bull flag. We're starting to come out of the gate here with a little bit of move to the upside. So a little bit of bullishness on the index, on the NASDAQ here. Russell 2000, kind of the one that kind of has been going the opposite direction here a little bit. And from that standpoint, we've got kind of this rally up, pullback, 3-day pullback in the small caps. I'm interested to take a look at this in 5-day 5-minute period because we saw a much longer move to the downside. And arguably, here's the thing. We've talked about this before, the fact that interest rate cuts tend to have a bigger, more exaggerated impact on the small caps, simply from the standpoint of, those higher borrowing costs, more perhaps aggressive borrowing. And so some of those things are, kind of giving us that expectation that we think maybe with a rate cut, the small caps would benefit maybe a little bit more, and they're not yet. I mean, we're maybe starting to see that get digested here, and that moved back up to the upside. Because the other thing we got to keep in mind is the fact that the small cap index, the Russell 2000, falls also within that characteristic of the financials. We have a fair influence from the financials. And so financials, interest rate cuts are a double-edged sword. So we're starting to see that, maybe that move here just a little bit to the upside, see if that can continue to bounce up past that resistance level. So kind of a mixed bag. Now let's do this. Let's take a look over here really quickly. And I know there are a lot of questions going on regarding this. Let's take a look at the VIX grid. And as we take a look at the VIX, the one thing I happened to notice, and I talked a little bit about this earlier today in a couple of posts, was the fact that that VIX was below its average. This is the VIX, the volatility index. This is a measure of option premium, if you will, on S&P 500 index options kind of across the board. In the money, at the money, out of the money for a 30-day average. And when there is buying activity in those options, whether it's buying activity on the call side or buying activity on the put side, general put side buying drives this higher faster. We tend to see that VIX spike. That's why it's used sometimes as that fear gauge, because institutions tend to panic and buy put options to hedge long stock portfolios. Something we're going to talk about here in just a minute. We saw that activity starting to happen a little bit. We're now starting to see this fall off just a little bit. So this is the VIX index. Now, there are index options. In fact, we've traded index options in this class a couple of times. Let's see if we go to VIX and we pop those in here. We're going to see those index options. Now, there are some characteristics of those index options given the fact that they are AM settled, which means that they settle not on the closing price. They stop trading on the day of that settlement, but they settle, or the day of that expiration, but they settle based on the opening print the next day, which gives them some overnight risk. And that's a challenge when trading some of these index options, the fact that there is that overnight risk, especially if you hold on to an option through expiration. If you don't hold on to the option through expiration, then it somewhat mitigates a little bit of that challenge. But, you know, this is an area where investors, and we've talked about doing this, and we've done this, in fact, is can use the movement of the volatility index, the VIX, as a mean to either speculate or to hedge. But the VIX starting to rise just a little bit today and then falling off a little bit, staying well under, at least at the moment, under that moving average. This is a 30-period moving average of the VIX, which is in and of itself an effective 30-period average or 30-day average of option prices. So the VIX is relatively low at the moment, even though it popped up a little bit initially. It seems to be bleeding off a little bit, which is benefiting short option positions that maybe we have on some of these index products. So the VIX kind of coming out of the gate here, a little bit of elevated VIX, but not abject fear by any means. And once again, it's starting to bleed off. The question is, what does the market do from here? And is there the potential that as this VIX is relatively low and as the SPX, this is that comparison, the purple line here is the SPX relative to the VIX, is there the potential for that SPX to see a little bit greater pullback, even with the interest rate cut, from a buy the rumor, sell the news perspective? And so that's the question that lies, at the feet of traders who have long stock portfolios. Is there something we can do to offset some of that potential risk? So we're going to talk about hedging using index options here in just a moment. The next thing I wanted to do really quickly, I want to pop over here to our index grid, and we're going to go to the webcast, or the strategy that we've been talking about for almost, I think maybe even a little bit over a year now. And that is this strategy of as the market moves on the SPX, using that as the definition of the market, selling a vertical spread on the index options and selling it in a biased direction based on what the market is doing. So here's the first scenario, right? Here's the first scenario. We look at market direction based on where it is relative to the 200-period moving average. And that's what this blue line is on this chart on the left-hand side here. We can see that the market is way elevated above the 200-period moving average. And some of you are saying, well, wait a second, that's just ridiculous that we're still selling calls or put spreads here when the market is that high. It's got to come down. It's got to crash. It's got to move back to the downside. Well, you know what? It doesn't got to do anything, unfortunately. The fact that it's well above that 200-period moving average doesn't necessarily mean that it has to reverse. It can still trend in that direction, and that 200-period moving average will move to adjust and to catch up with that. And as it does that, then it becomes less far from that moving average. So we're still using this as kind of that longer term trend direction. Now, we could use a shorter term moving average, in which case, if the market were below, say, for instance, the 50-period moving average, we would sell call spreads. But since it's above the 200 period, it's above the 50, it's above the 100, we're selling put spreads and taking advantage of this upward movement. And the goal here is very simply to take advantage of the most inevitable of the forces that we have. I don't know what direction the market's going to move, and I don't know what implied volatility is going to do. But I do have, with generally a pretty good certainty, but not 100% certainty, I do know almost for sure that the sun is going to come up tomorrow. Time is going to pass. So we're going to structure this trade, and we have been structuring this trade to benefit from the initial passage of time and how that impacts our option trade. So time's always working in one direction, and it's always eating away at premium. The value of an option, index option, equity option, or otherwise, is always decreasing at some rate based on how far it is from expiration and what its other influences are. But primarily, it's decreasing in value as it goes towards expiration. Now, other forces could overwhelm that. So we're going to take advantage of that rapid or more rapid decrease. So what we're going to do is I'm going to go over here to the index options or to the options chain on the SPX. And we're going to look out 14 days from now. That's the 12 November expiration, 14 days from now. And what I want to do in this particular case is, now that I know that date, that's the 12th of November, what I'm going to do is I'm going to come back over here to the chart. And I'm going to use the right-hand side, which is simply a 3-month daily, so it's just a zoomed-in view. But I've also put on here a cone, not a cone of silence, but a cone of volatility, the probability of expiring cone, which its width is based on implied volatility, how elevated or decreased implied volatility is. So implied volatility goes up, the cone is going to get wider. Implied volatility goes down, the cone is going to get narrower. And what we're going to do is I'm going to remove this time hack. The tool that I'm going to use is in the drawing tools. It's this one right here. It's the little clock icon with the vertical line. That's our time level. And so I'm going to go out to the 12th of November. 11/11, 11/12, right there. That's my time hack. And I'm just going to put that on there. I'm going to put that vertical line on that time hack on the 12th of November. And then what I'm going to do is I'm going to grab my line tool once again, just like we do every week. And I'm going to come back in here and I'm going to say, all right, where is that crossing over? And it's crossing over at this point. And again, not getting too particular, too precise, but at about 66.60. 66.60 is the crossover. Okay. Now, Harry says, well, wait a second. If you're going to take $2,000 of risk in the spread, wouldn't you stand to make more money if you use 4 times the spread times 500? And that is a possibility. One of the things that we can look at. But remember, we're also kind of balancing this against transaction costs. We're balancing this against the probability of taking that risk. So if we're going to reduce the risk, we're probably going to increase the probability that it's going to get hit if there is a big move. So those are some of the factors to keep in mind. Now, what I want you to notice too is something significant happened. For those of you that were here with me last week, last Wednesday, notice something that happened here. Over the course of the last few weeks, what's gone on, because I've left each one of these lines in place. So this line was 4 weeks ago. This line was 3 weeks ago. This line was, 2 weeks ago, 3 weeks ago, 2 weeks ago, 1 week ago, and now today. And you can see what happened. Implied volatility, and you can see plotted against implied volatility, the range where that line is or where that crossover is has changed. Now that implied volatility has decreased overall, the VIX has decreased somewhat. It's come off of these big fear levels. That probability of expiring cone, because remember, that's going to be an average in and of itself, that's come way back in. So relative to where the market was, because the market's moved up, and relative to where this crossover is, this is quite a bit closer than where we've been before. Because when we were doing this last week, we were kind of somewhere out here. We had that range there. So that's something we want to pay attention to, is the fact that this is kind of coming back in a little bit closer. We'll see what that does to delta, because that's going to be our indication of the likelihood of this trade getting hit. So now that we know where our crossover is, 66.60, we're going to come back over here. Oh, yeah, you know what I completely forgot to do? I completely forgot to manage the one that we're currently in. I went right down the road of doing a new one, but I want to go to the monitor tab here. Here's the one that we're currently in. We sold this last week for $2.10. It's now trading for a quarter, 25 cents. So we're going to right click and we're going to create a closing order, and we're going to buy this one back. Now, I know we always get the question, well, why don't you just leave that one to expire worthless? And the thing is, we're still carrying the risk in that trade for the sake of an additional 25 cents. I'd rather not carry that additional risk over another week. Now, 1 day's time, because we did a 0 DTE trade last week, and somebody asked me the question, well, isn't this just the same thing as picking up nickels in front of a freight train? And the answer is yeah, but over a very much more defined time frame. Here, we've got 7 days of potential market movement to pick up an additional 25 cents. So we're going to spend that to buy it back, or to sell it back for that, and sacrifice that last little bit, and be okay with it come what may, because we're moving on and we're redeploying this available capital to do something else. So I'm going to go ahead and click on confirm and send. We're going to buy this one, or actually we're going to sell this one back. No, I'm sorry, buy this one back, because we're selling vertical spreads here. And we're going to send that off. And now we've closed that one down. Yeah, thank you, Brent, for sure. You're taking up that buying power. That's another consideration. So now we're going to go out to 14 days to go till expiration, and we are looking for the put spread, because we're selling put spreads here. We're looking for that 66.60 level, and that's about the 15-cent delta at the 66.60. So our goal is to not have this end up in the money, actually have this end up be out of the money. So we're going to sell this far out of the money, low probability of being in the money, in this particular case. So we're going to sell the 66.60, and we're going to buy the 66.40. We're going to make this 20 points wide, like we have been doing. Now, it's not a very directionally sensitive trade. The net delta is low. Generally, you can get out before at 80%, sure, if you want to, that's fine. Just for the consistency of this class, I've just been doing it at 14 and 7, 14 and 7, 14 and 7, regardless. So if we can sell this for about $2, $1.90 to $2, and bring in that premium, that's what we're going to do here. Click on Index Options Weekly. We just created a vertical spread. $200 is what we're bringing in against a potential maximum loss of $1.80 or $1,800 for the contract. And you think, wow, that's not a very good return on risk. But at the same time, think about what that means. This is a low probability of being hit, and a 1 week time frame. So the return on risk in this particular case is the lesser of the concerns. The fact that this is not a 1-to-1 or a 2-to-1 reward to risk ratio type of spread. I'm willing to accept that theoretical maximum loss for the sake of this being a high probability trade, playing to the advantage of time decay and a low probability of getting hit unless there's a big market movement. In which case, we still have that potential to get out of the trade prior to it taking that maximum theoretical loss if we're paying attention. So I'm going to go ahead and I'm going to click on send. We're going to fire that order off. And we got it for $2.20. So implied volatility got a little bit of pop there. Got it for $2.20, which is more than what we've picked up for the last few, which is interesting in this particular case. And so what we'll do is we will come back next week and we will look at that trade and we'll look to buy it back for less than the $2.20 that we were paid for it to begin with. That is the goal. If it goes the other direction, here's the thing, and one of the reasons why we're kind of shading this towards the selling of put spreads or the selling of call spreads in this particular case is we're able to bring that premium in, generate income on an ongoing basis consistently. Not a guarantee that that will continue to happen, right? I'm not saying that this is the infinite money machine, because it absolutely is absolutely not. Markets can move, markets can change. There is risk involved in this spread. Be aware of that risk and know it. But at the same time, we've kind of done this in a way, high probability, shorter time duration, so not as much time for the index to move around. And we're doing it with a European style index, which means that there's not the risk of early assignment. So we're using this as this is a put spread. So we're using this as a context on the context of simply generating income. So the amount of portfolio are we risking on this particular trade? I'm position sizing to that maximum theoretical risk. So that max theoretical risk in this particular case was $1,800. So if my risk tolerance is less than that, narrow the spread, use a different instrument, for instance. Use the XSP, which is a tenth of the large index. Other instruments could be used to do the same thing, just simply illustrating the characteristics of this particular trade. So, and that really holds true to a lot of the spreads that we trade and we'll talk about in this discussion in terms of the percentage of the portfolio that's getting allocated. In terms of that risk tolerance, it is allocating or position sizing to that max theoretical loss in the trade. We don't necessarily want to put a stop on this because there's the possibility that we could get stopped out on intraday volatility or pre-market or post-market volatility and take us out and then go on to do exactly what we wanted it to do. So that's kind of the structure in that particular case and putting that trade on. Now let's do the next scenario here. And that is kind of going back to this idea of one of the more traditional ways that traders may use a portfolio or use index options in a portfolio is to hedge. And this is maybe acting a little bit more like institutional investors, is using index options as a means to hedge against the possibility of adverse movement in a long stock portfolio. So I happen to have a group within my my platform here called my beta weighting group. And the only reason it's called that is because I use this as kind of a cross section of stocks. So I've got Amazon, I've got Boeing, I've got ConAgra, I've got Delta Airlines, Disney, Coca-Cola, Vistra, Walmart. So I've got a little bit of technology, I've got a little bit of communication services, I've got some consumer staples, I've got some consumer discretionaries, I've got communication services, I've got industrials in there, kind of across the board, kind of a cross section of the SPX. And what I've done is I've beta weighted, because each individual stock has its own delta and it moves in its own way. But when it moves up $1, we gain $1, moves down $1, we gain $1 or lose $1 for every share that we own. So it's got its own kind of movement. But if each one of those has its own kind of movement, I want to have a kind of a common denominator, or a common coefficient. So I'm going to use the beta weighting tool. And we've talked about this before, using the beta weighting tool. And I'm going to beta weight this portfolio by turning all of those individual stock deltas using beta, which is a commonly accepted coefficient of movement. We're going to turn all of these deltas into SPX deltas instead of Amazon deltas, Boeing deltas, ConAgra deltas, Delta deltas. I just put that in there just so that I could say exactly that, Delta deltas. But we're going to make these all SPX deltas. And so this portfolio, or this portion of the portfolio, is long 18 SPX deltas. which means that if the SPX goes up $1 or a point, then our portfolio should gain theoretically 18.3 points or $18.3. Likewise, if the SPX were to go down $1, this portfolio should lose $18.3. Now remember, A, this is dynamic, it's going to change. B, there are other forces at work. And C, this is theoretical. So don't get wrapped around the axle trying to calculate absolutely or come back at me and say, it didn't move exactly $18.31 based on a dollar movement. Well, yeah, but because there are other forces at work. But this is really kind of the very thumbnail kind of approximation for the sensitivity of this portfolio to the movement of the S&P 500. So if my thought was, and I look at the SPX and I'm thinking, hey, maybe this is going to pull back just a little bit. I want to protect my larger stock portfolio, this Amazon, Boeing, CAG, Delta, Disney, Coca-Cola, Vistra, Walmart portfolio. I want to protect that against adverse movement. What could I do? So I could go out and I could put stops on each one of these individual positions. And that might help. And it certainly would be better than nothing because it would give us a point at which we're willing to get off the bus for each one of those rides. But that's going to be challenging to kind of keep up with that. And as this portfolio grows, that's going to be more challenging to keep up with those stops on an ongoing basis. So I could buy put options on each one of these individual stocks. And that's going to be relatively expensive because I've got to go in and I've got to buy a put option for each one, and then I got to manage that put option to protect against that adverse movement. I can sell calls against each one, but that may create some pretty substantial obligatory risk if I am creating covered calls against all of these positions and then the market were to move higher. So what I might do in this particular case then is use kind of the opposite side of what we just did with that SPX short put spread, and I might use an SPX short call spread to offset risk. Now, two ways that we could do this. We could buy an SPX put, an index put. That's going to be relatively expensive. Let me show you what that would look like, though. If we were to go to the trade tab and we were to go to the index options, and what I'm going to do is I'm going to go out actually here. I'm going to go out 20 days. And the reason I'm going to go out 20 days is that's the next monthly expiration. It's the 18th of November. Actually, this one is the next monthly expiration. It's the 20 November one, right? And that's going to give us about 22 days of protection if we're thinking about it from that standpoint. And if I were to buy a put option and I were to say, hey, you know what? I've got 17 long deltas here. If I wanted to reduce that to neutral, I could go to that trade tab and I could come over here and I could say, hey, where is there a put option that would reduce about 17 deltas? If I were to buy 17 deltas or minus 17 deltas, or buy, another way to think about it would be buying 17 negative deltas, because these are puts. If I were to buy this 6,600 strike put option, I'm going to pay, if I click on the ask price, $29.70 per share times 100 shares. In other words, I'm going to pay almost $3,000 to buy protection. Thank you, Martin. I'm going to buy almost $3,000 to buy protection against this price moving. It's going to be expensive. But if I were to do it, let's just do this because I can do this in this particular account. I'm going to put this in my beta waiting account and I'm going to click on send and I'm going to fire that order off. So I bought it for $29.40 per share times 100 shares, so $2,940. But if I go over here to the monitor tab, look at what it did. Those 16 or 17 net deltas that I bought have reduced my portfolio sensitivity to the downside to the tune of about 17 deltas. And so I'm left with about a delta left, one delta left. This has a little bit, but the problem is a little bit of downside sensitivity also has a little bit of upside sensitivity. So if the market starts to rip, well, I have that cost of that long put option that is getting, you know, less expensive. I can't sell it back for as much, so I can't recoup as much. And it's attenuating somewhat my upside gain, right? Now, here's the other thing, though. If in order for this to kick in order for this SPX option to kick in terms of gaining intrinsic value, Where does the price of the index have to be? It's got to be below 6,600, which is below this major level of support. So, this is protection. It's effective protection, but it's pretty crude protection. So let's do this. What if we did this instead? Let's come back over here to our monitor tab. I'm going to get rid of that one. Right click, and we'll just create a closing order. We'll sell that one back, and maybe we can get pretty close to what we paid for it. And we'll sell that one back. Okay. Now we're out of that one. We've eliminated that protection. We're here at the monitor tab, and we're going to come back over here, and we're going to say, look, we're back to being long 18.35 SPX deltas. So what we might do is go the other side of the equation. Let's go back to the trade tab and say, fine. That might be the level at which I want to protect this. But what I want to do is I want to go out and I still want to reduce my portfolio exposure by those 15 deltas or 18 deltas. So you know what I might do is I might come in here and I might say, look, let's see where we can get some premium. And let's see if we can create a spread that has a net delta remaining of about 17 deltas. So let's just do this kind of systematically here. Think about this in terms of probability. We want to still be kind of at around that same probability. But that's going to be hard to do because the further out I go, the less premium I'm bringing in and the less opportunity that I have to offset some of that probability or those deltas. So let's do this. Let's make the math easy here. I'm going to make this math easier on myself. And I'm going to say, fine, let's sell the 7,000 strike. That's kind of a big round number. And if I were to sell that 7,000 call, right, this index option, and if I were to stop right here, this would be a naked call. But I do that, and I'm going to bring in that $4,000, but I've got infinite maximum risk because the index could go up infinitely. Now, I'm probably not going to be able to carry that off in terms of account capability or risk. That's a infinite's a pretty fair amount of risk. So what we're going to do is we're going to turn this into a vertical spread. So think about this. If I've got 30 cents, let me change this to my calculator. If I've got 30 cents of long deltas here, and I want to get to 18 cents of long deltas, how much do I need to reduce that long delta exposure in this particular, excuse me, hang on. I sold this one, so I'm short 30 deltas. How many long deltas do I want to add to get this down to a reduction in my portfolio of that 17 or 18 deltas? So I got to reduce that by about 12 deltas. So I'm going to come down here to the 7125, or maybe even the 71. We'll go to this one, the 7100. We'll just use this for easy math. And I'm going to buy the 7100. So now I'm creating a short vertical spread. And the short vertical spread, I'm short the 7,000, I'm long the 7,100. It's a $100 wide vertical spread, so it's a big vertical spread. But for that, I'm going to bring in $24.85. So I click on confirm and send, and here's the trade-off. I'm bringing in cash into the account, $2,475. My max theoretical loss is $7,525. So I'm not paying $3,000. I'm bringing in almost, $2,500. But my loss, my potential maximum theoretical risk, if the price of the index were to go up all the way through that 7,100 level, is pretty substantial. So I got to be willing to take that risk in this particular case. But if we put this on, and I put this in my beta waiting group, and I click on send, and we fire this order off, and we got this for $25.30 times 100 shares. But now we go to that section, our monitor tab, and you can see what we've done. We're essentially short 15 deltas. We were long 18 deltas. We're now left with about 3 deltas. Now here's the thing. It's over a limited time frame, right? We know we've got an expiration date. The passage of time is working in our favor as opposed to working against us with that long put option. And if the price of the index doesn't move, we're still at kind of a high probability, not as high as that option, as the long option, but we're still at a relatively high probability of this being out of the money at expiration. And it reduced our sensitivity. And we really do, in this particular case, still have a little bit of upside potential. Now, we don't want booming upside potential on the index as a whole, but we can afford a little bit of upside movement on some of these individual names and still have a little bit of delta sensitivity to the upside in the overall portfolio. So that's using an index option short vertical spread as a means to hedge. It may not be as efficient. If you think about the maximum loss, it may not be as efficient from a maximum loss perspective as the long put option, but it is bringing in cash up front. That's serving as our downside offset. And if we don't get downside movement, we get to keep that cash. And so that could be accretive to the portfolio as a whole. But if the market does move down, that works in our favor. It offsets our portfolio to the tune of that $2,500 that we brought in. If the market moves up significantly, we could end up taking a significant loss. So that has to be factored into this equation. So what we did in this context is we managed our weekly vertical spread, and we used a short call spread on an index option to offset our potential risk in our long stock portfolio. If you want to learn more about these concepts, pop over here to the Trader Talks webcast page on YouTube and type in hedging. And I tell you what, Brent Morris has some great webcasts in here talking about hedging. When can you hedge? How can you hedge using long options? Protective puts to hedge a position. Connie Hill, Cameron May. Here's Brent Morris talking about exactly what we've done today in this discussion, just about options in general. You don't have to use index options, but they take out that early assignment risk. So that being the case, now think about this. If you shift some of these strategies to other products, if you're looking at selling these option spreads, remember some of those other products may be American style and still have that early assignment risk that European style index options do not have. So follow me, follow Brent on X. I'm at Ben Watson CS. Brent is at Brent Morris CS. And just give us a quick follow there where you're on that Trader Talks webcast page. We'd love to have you give us a follow. Click on that subscribe button down at the bottom of the page. My thanks to all of our great producers and our great reviewers for helping us to bring this webcast to you guys. Go out there and have a great day. We will see you again very soon in a bunch of other webcasts, our 30 plus hours of education that we do every single week. We'll see you then. Take care, everybody. Bye-bye.